Hello, everyone out there. I hope you're all doing well. If anyone is out there, can you go ahead and give me a sound check? Just let me know how the mic is coming in. Appreciate it. So hope you all had a good weekend and you made a dent in your Christmas shopping. Holiday season is upon us. Christmas is just a couple weeks away. And again, hope everyone out there is doing fine. Hi Giselle, how you doing? Glad you could be here. American Rebel 27. Great. Glad you're here as well. Guys, can you let me know how the sound's coming in? And then I'll be starting in just a bit. So sounds good. Okay, thanks. Thomas Tubes, how you doing, buddy? Hope everything's going well out there. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and this is the live stream. Glad you could be here with us, whether it's Sunday night, wherever you're at, or whether it's Monday morning here in Asia. Again, glad you could be here. And again, if you are new to this channel or you have not already done so, please don't forget to subscribe. Click on the bell to be notified on new updates and give us a thumbs up if you like what we do. We really do appreciate your support. And again, we're glad that you could be here. Dan Warsaw, thank you. Appreciate it. Glad you could make it. I think this is the first time I've seen your name as well. So welcome aboard. Nameless. Let's see. The money you put in the banks in some Latin countries isn't really yours. It's the bank. I think just about every bank, yeah, the money that you put in the bank, you become a creditor to that bank. The bank is going to use your money, and then it's going to have to basically have an IOU for you. So all banks, I'll just say all banks in general, banks, um, yeah, you put that money in, and they're going to use it. So it's a good point. Sean McDonald, how you doing, buddy? Thank you, appreciate it. Let's see. Cypress Bellin taught me a lesson, Nameless. Yeah, it taught a lot of us a lesson. And the thing is, it's not something that we can glance over and walk away from, because this is something that we are continually going to be walking into. We're not walking away from it. We're going to be walking into it and walking into more of these things. So again, glad you all could be here. You always can find us on social media. Our website is silverbullion.com.sg. SG because we are in Singapore. Facebook, Silver Bullion SG, again, Singapore. Twitter, you can find us at SilverBullionPL, PL for private limited. And you can find just the audio versions on bit.ly, bit.ly/SBTV iTunes or /SBTV Spotify. And we do hope that if you do have the Telegram app on your mobile phone, join us. Join us at Crisis Tracker, and here we'll go over some of the news articles that come across as they pertain to either economics, especially gold, silver, things like that. So it's our way of staying in touch with you in as many ways as we can. So again, we appreciate you all being here. Frank, how you doing? Lance Harrison, how you doing? Norman Liu, how you doing? My name is my name is Nobody. How you doing, Nobody from Florida? Well, you're somebody when you're here, so we'll have to change that name for you. Thomas Stoops, also true in the U.S. Absolutely, banks. In fact, we're going to get into something later in the show where you're going to see just what Congress is proposing has something to do with banks in some ways. It actually is more with your pensions. Let's see. Only keep enough in the banks to cover your bills. Amen. Amen to that. Put it under your mattress. Well, hopefully not. Hopefully not. Hopefully not. Joe Johnson, how you doing, buddy? Let's see. Nameless markets on precious metals can go down, but it won't go to zero. Absolutely. Of course, it can go up and down, up and down. I think most of us understand that, but we also understand, it's really fiat that paper money you're holding in your wallet. That's the one historically uh, tends to go all the way down. Tends to go all the way down. So, again, cash is good to stock up on. Have enough cash because that's going to be there for you when you need it, especially when things first start to roll. You're going to need that cash, but later on I think we're going to be walking away from that cash. So, remains to be seen. But for now, I know most of us are in gold and silver, and I think that's where we should be. So, let's take a quick look at the price regarding gold and silver. This is from our website, silverbullion.com.sg. So, here we have it in US dollars, and we'll go down. Silver basically unchanged, right about that $17 per ounce range, which is good. I gotta say, silver's been pretty resilient. It keeps getting pushed down, 1650 ish even, and you give it a couple days, 2 3 days, and it's working its way back up to 17. So gotta say, silver is pretty resilient right now. Gold, once it came down from that 1450, it's been having a hard time trying to get back up there, and we do see it come up to exactly where it is, 1475, and then we see it start to struggle a bit. So let's see if it can get over that hurdle and break back into that $1,500 range by end of the year. I'm hoping it does. Nickel and cobalt, these two metals here, they're metals that go into lithium ion batteries, which are for electric vehicles. Demand for these two metals, it is there. The demand is there, but the price action, it's not reflective of the demand. So, these two metals we got to watch. We really need to keep an eye on them. Cobalt, I don't think we need to check on the cobalt price. I've seen it here for a while, so we need to check on the price and see what's going on with that. Nickel, the same. It broke back into 14,000 range. Hopefully, it'll go back up to where it was, 17, 18, and we'll have to see where those go to. Looking at the ratio right now, we're at 87. 87 basically means it's a very good time to be buying silver. If you're stuck between trying to buy silver or gold, the ratio is one thing that people will use. And if you use this ratio right now, it's telling you it's definitely a time to buy gold. Uh, Sign up for storage. Definitely, we do have the way we operate in storage is. I'm gonna say it's very different in a lot of aspects compared to other vaults. And of course, don't forget to download the investor kit. All you need to do is click on it. And again, this is a free investor kit. It's free for you, and there are a few nice items to look at in here that helps explain a few things, such as why buy gold and silver, tax exempt bullion in Singapore, why silver especially, and this here bullion genuinity guarantee. Basically, a lot of people, they put their gold and silver in the vault, or they buy, and it goes directly in the vault. And the thing is, was that silver or gold really tested, or what if it down the road shows up not to be as pure as it says it is, or if it's not even what it says it's supposed to be? And that's one of the other differences. Vaults, they're into storing. Our vaults, or our vault, I should say, singular, is into storing and testing. We're going to make sure what you have is what it says it is. Other vaults, you put it in there, you may never know. It's just going to sit in the dark, and a lot of times you don't know unless they really test it for you. So again, those are a few of the items that we have in the investor kit. So getting back to some of your comments here, uh, banksters, yes, banksters. With China, fact, with China coming out with their own crypto, what will that mean for Bitcoin? They might put their citizens in concentration camps, I suppose, if they refuse. In fact, that's going to be interesting. And I do have an article that I'm going to pull up later on that has something to do with what you're talking about right here. So we'll touch on that more towards the end. Thomas Tubes, foundation of the U.S. dollar is being shaken as we are watching this. That is true for a number of reasons. People wanna or countries want to get off that U.S. dollar, and if they do, expect a very big change that's going to happen. And with the currencies, and the dollar being strong right now, the dollar, in some aspects, does have to weaken somewhat. But the problem is, if the dollar weakens, I think you can bet other currencies going down as well. And as some people like to describe it, currencies are on a parachute right now. They're all floating down in this wearing type of a parachute, floating on the way down to the bottom. So it's like as some people say, a race to the bottom where they're all wearing parachutes. And that means people like you and me, we need to be mindful of this. Can't turn a blind eye to it, but just be mindful of it and understand how gold and silver, things like that, are stores of value. Because if these currencies are on a race to the bottom, you are going to need something to store the value of your currency, your hard work. Pablo Pina, I'm doing fine. How are you today? Let's see. Bam City, where do we want the ratio? I think it's not a question of where do we want it. It's more like what the ratio is telling us. So definitely right now, if it's in the 80s, or I think in general, anytime above 50, 60, 70, you want to be you want to be in the silver. And then anytime it's, let's just say 50 and below, or 50-ish, then you would probably want to be going more towards the side of gold. So it just depends. I know in the beginning when I first started buying silver, I was loyal to silver. I didn't care about gold, just silver, 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 silver. And then after a while, you kind of realize, you should actually have some gold for a certain amount of silver that you buy. Maybe even a personal ratio where for every 100 ounces of silver you get, be sure to pick up an ounce of gold. But you should have the both. You should have both metals. Let's see. Jonathan Dixon, we will see tomorrow if there will be a repo apocalypse. Yeah, we're gonna get into to repo. I tell you what, it's blowing up. I mean, I'd like to get off the subject of repo, but the Federal Reserve just won't let us get off the topic of repos. It keeps coming back and coming back and coming back. And so the Fed just had their FOMC meeting, and but right before the meeting, Jeff Gundlach, he had some things to say about the repo market, what the Fed was doing, and what he felt they were going to do at the FOMC. So I'd like to take a quick look at what Jeff had said back then before the FOMC meeting.
What happened was the Fed thought they had a framework that was working. The markets threw a temper tantrum about it, and they were forced then to go back to basically the Fed model that we've had for quite a few years now, which is following the market rather than, the great Paul Volcker just passed away this week at age 92. He was the one that really had control over what the interest rates were and wasn't just listening to the market. And I wish that if the Federal Reserve has a purpose, it should be to have an outlook and follow it regardless of what the market does. And instead, Jay Powell capitulated and went along with what the bond market has said. And now the bond market's completely in sync with the Fed. I mean, you have Fed funds rates, the same basically as the 2-year Treasury, which is kind of the same as the 5-year Treasury, which means that the Fed is now comfortably on hold. But what Jay Powell has done is he raised rates 4 times and in 2018, then cut rates 3 times in 2019. We basically have gone nowhere. We've just put ourselves on kind of a wild ride, which I believe was unnecessary.
Are you against the concept and the idea of an insurance policy? Because that's what it was. It was taking out an insurance policy unless things got bad because of the trade war and other issues, be it geopolitical or otherwise. You can throw Brexit into that stew and the uncertainty of knowing where all of that was going to play out. What's wrong with an insurance policy?
Why did you raise rates 4 times in the first place is my reaction to that. There's nothing wrong with adjusting policy, and you can call it insurance policy, you can call it a mid-cycle adjustment if you want to. But it doesn't seem to me that there's much chance of the Fed really following through on this mid-cycle adjustment concept, because that would mean that we're going to raise rates again. Yet Jay Powell in October said to raise rates, we need a substantial increase in inflation that is persistent. So even if inflation goes up, what they're telling you is there's no intention of raising interest rates unless the dynamics change pretty remarkably. So all we did was raise rates 4 times just to cut them 3 times. We should have just left them alone the whole time, is my opinion.
Do you think he should be replaced? I mean, he's taken fire all year long from the president.
No, I don't think he's any different than you would replace him with.
Yeah, okay. I think we kind of get the gist of this one also, and I know a lot of us, we were already saying, why is the Fed raising rates? It's because they're going to have to. They need a little bit of a runway for the next recession in order for them to cut rates. Typically, it takes roughly 3-4% or so, something like that. Where if a recession hits, the Fed would need to cut back 3-4% or so in order for that recession to subside a bit. So a lot of us were feeling at that time, why is the Fed raising rates? It's because they know recession's coming. They need that little bit of a runway. But now what they're saying is the Fed may not raise rates anymore. And if that recession does come on, which a lot of us are expecting, and they don't raise the rates, we're at 1.5 right now. We're going back down to 0, maybe even negative, if it takes, again, that on average 3-4% or so for that recession to subside. So, I think we're in some very interesting times to say the least. But after the FOMC decision, CNBC came out with this article. Again, they left it unchanged and indicate no changes through 2020. Again, if there's no changes and a recession hits with that average of 3-4% of rate cuts needed for that recession to subside, we are going to hit bottom, 0% or negative. So the Fed kept its benchmark rate in a target range of 1.5 to 1.75 as expected, even as what Mr. Goodluck said. The dot plot of individual members' future projections indicated, on balance, no hike in 2020. Again, that's pretty significant. And the committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective. Okay, I think Jay Powell has been doing a lot of cutting and pasting over the last few months, because we've been hearing this over and over and over, almost word for word. So you got to change your words sometimes, Jay, because it looks like a lot of cut and paste going on. We're seeing the same thing over and over. Nonetheless, the article goes on to say Federal Reserve held interest rates steady following its 2-day meeting this week and indicated that no action is likely next year amid persistently low inflation, concluding a year that saw the central bank take down its benchmark rate 3 times. The FOMC on Wednesday met widely held expectations and kept the funds rate in a target range of 1.5 to 1.75%. In its statement explaining the decision, the committee indicated that monetary policy is likely to stay where it is for an unspecified time. That specified time might be the recession, the way things are going. Anyway, sorry about that interjection. The officials will continue to monitor conditions as they develop. The decision to keep rates unchanged was unanimous following several dissents in recent meetings. Correct. This time, everybody voted the same way. The committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity. Did you folks get that word? The monetary policy is appropriate to support sustained expansion of economic activity. Strong labor market conditions and inflation near the committee's symmetric 2% objective. Statement said on and on and on. Okay, so I think you guys are kind of getting the point of this, right? I think basically the Fed doesn't know what to do, so it's going to do nothing until something happens, and then it will try to do something. So, again, interesting times where we're gonna. I think things need to get shaken down a bit. We can't keep going through this over and over and over, and we got to talk about other things besides the Federal Reserve and repo markets, right? Otherwise, we're stuck on these things if these guys keep doing the same things. Let's see what's going on in comments. Dutch partisan, please explain why I would need gold with an 80s. No, Dutch. At that time, you'd want to be looking at silver, not gold. Maybe there's a bit of a miscommunication or misunderstanding there. But if the ratio is 87, you want to be looking at silver. So in case I misspoke, it's silver, not gold. Okay, so that's what you want to be looking at. Um, Mark W. It is insane to expect infinite expansion in an infinite world. It expansion is just incredible. It's just been going on and on and on, and no end in sight. It's almost like a few of us older guys here. We remember that movie Weekend at Bernie's. That seems to be where we're at right now, where the Fed needs to keep pumping in money. Bernie's dead. Bernie meaning perhaps a few banks, perhaps the economy, perhaps repo market, whatever it may be. But in this movie, this character Bernie is dead, and these guys have to come in and prop him up and make him look like he's alive, so this party can keep on going. And right now, at this point in time, what the Fed's doing reminds me of this movie Weekend at Bernie's, and I don't know, it just reminds me of this movie right now, where the Fed is having to prop everything up. And if you're propping things up, that means that things are trying to fall, maybe perhaps even fall to zero or fall to their death, so to speak. Anyway, Mark W. Okay, we read that one. Timothy Mack, the Fed and the tangible economy are playing chicken. I that's a nice way to put it. So we'll leave it at we'll leave it at that. It's a nice way to put it, though. Let's see, Dutch partisan. I'm a silver bug on a purchase regime, by the way. There you go. Okay, so we had Jeff Gundlach saying the Fed wasn't going to do anything, and why are they just basically going, they're going nowhere. Basically, they're going nowhere. They're not really doing anything, and so I want to take just a quick look at the Fed balance sheet. I think we're all starting to get familiar with this chart here. Let me push it up a bit so my head's not blocking. In fact, let me go ahead and take my picture off here. Okay. So right now, this is where we're at. Okay, the right hand side, far right hand side of this balance sheet. This is the Fed balance sheet. Okay, so we're here now. This is when this whole repo market shenanigan thing started happening. And we see this little V pattern here where the Fed was tapering. Then all of a sudden, nope, we need to start injecting money again. So this is this little V pattern going on. The interesting thing, and by the way, this is not QE now, right? We don't say this is QE. We're all forbidden to say this is QE. The interesting thing was back in late 2010 into 2011, which puts us around here, November, December 2010 to about June, July of 2011. This here is QE2. This section right here is what's known as QE2. And if we take a look at this area right here, this is where $600 billion were printed up or injected during this time period from November, December of 2010 to about June, July of 2011. So let's just call it 6 months. 600 billion was injected right here. This is QE2. And we take a look at not QE. We take a look at not QE, and the way this thing is going to project out, not QE is either going to be stronger or more significant than QE2, or really, depending on how things go, will we end up back at QE1? So either way, right now, what's happening, it's going to be either equal to or greater than QE2, even though we're not supposed to call it that, or will it possibly even challenge QE1? And the reason is because, a lot of people have been saying the Fed is going to inject, or the Fed is going to be very, very active in the repo market once again. And even Congress is getting a bit concerned with what's going on about this. And Congress, they did hold some hearings, I think about a couple weeks ago or so, where they brought in Steve Mnuchin, the Treasury Secretary, and they asked him a few questions. And I want to go ahead and roll this clip for you guys, and then we'll go ahead and talk about it a bit.
Repos, the repurchases, because there are some flags here. And, last year, banks had the most profits they've had in forever, in part because of the big tax cuts and stuff like that, but huge profits. And at the same time, we saw the excess reserves of the banks decline by 35% since 2017. And at the same time, as the Fed and Treasury were sort of shrinking the balance sheet, all of a sudden over the last few months have had to expand it again. I don't understand how those all come together. And if you could try explaining it again, I'd appreciate it, because we got big profits, shrinking reserves, and now expansion of the balance sheet again. Those are the kinds of things that I think we have FSOC in place to monitor. So what is it that is really driving this on a bigger scale, if you could tell us?
So I'm happy to address it again, because it is a very important issue, and I don't want to minimize it. And again, as recently as yesterday at FSOC, we had a presentation from the Federal Reserve Bank of New York. I think there's a lot of different issues that came together on those 2 days that caused the spike. It was not any one single issue, but we are studying it carefully to make sure that this doesn't occur again, and to make sure it doesn't occur on a prolonged basis. The banks are having very good profits, mainly because of the U.S. economy is performing very well. I don't think this has to do with an issue of bank profits. This has to do with an issue of bank liquidity. The banks had plenty of liquidity. So the banks had enough liquidity to go in and take up the repo, but they didn't want to do it. And the reason they didn't want to do it had to do with different regulatory tests that fit together. So it wasn't, the liquidity test was fine. It was different ratios that they were worried about hitting and tripping. So again, this was partially a Treasury issue of tax day. It was partially a regulatory issue. It was partially a reserves issue. And then just to comment, as you said, the Fed has been shrinking the balance sheet, which I think makes sense, because as they went out of quantitative easing, they didn't need a giant. That was for the financial crisis. And what they're doing now doesn't impact the growth of the balance sheet by buying securities. It's really a cash management function around the repo market.
Cash management function. I don't know about that, Steve. We're going to have to dig into that a bit deeper at some point. But after the FOMC meeting, the Fed came out with this statement regarding repurchase operations, where the open market trading desk at the Federal Reserve Bank of New York has released a schedule of repurchase agreement or repo operations for the monthly period from December 13th through January 14th, basically 1 month. In accordance with the most recent FOMC directive, the desk will conduct repo operations to ensure that the supply of reserves remains ample. Stephen Mnuchin, you were just telling us these banks got a lot of, well, never mind. We'll just continue reading. Remains ample, and to mitigate the risk of money market pressures around year end that could adversely affect policy implementation. Okay, so what are these money market pressures that could adversely affect policy implementation? What are they? Well, we're going to have to see. Article goes on to say the desk will continue to offer 2-week term repo operations twice per week, 4 of which span year end. In addition, the desk will also offer another longer maturity term repo operation that spans year end. The amount offered in this operation will be at least $50 billion. Overnight repo operations will continue to be held each day on December 31, 2019 and January 2nd, 2020. The overnight repo offering will increase to at least 150 billion. I suppose because people are going to be celebrating New Year. They have those couple days off, so they need to make sure it's funded. And in addition, on December 30th, 2019, the trading desk will offer a 75 billion repo that settles on December 31st and matures on January 2nd. The desk intends to adjust the timing of amounts of repo operations as needed to mitigate the risk of money market pressures that could adversely. Okay, so it's all basically Jerome Powell speak once again. So, what does it really mean? And there was an article from Zero Hedge that came out, and they explained it in terms that we all can be familiar with. Massive, huge, largest ever. Fed will flood market with gargantuan 500 billion liquidity to avoid year-end repo crisis. Okay, again, what is this year-end crisis going to be where everybody is out celebrating the new year, and so they have to flood it up to make sure everything's going to go okay for everyone? Article goes on to say, in previewing today's Fed statement regarding repurchase operations on Tuesday, Curvature Securities repo expert Scott Skirm, not sure how you pronounce that, sorry, Scott, said that he expects the Fed to announce a 50 billion at least term operation for Monday, December 23rd, double the current term ops, and a 50 billion at least term operation for Monday, December 30th. This prediction was in response to Zoltan Pozhar's warning that reserve levels are too low, and the result would be a market crash that could spark QE4. We're getting pretty tight if they're just talking days and weeks. Well, moments ago, the New York Fed, excuse me, did publish its latest weekly statement regarding repurchase operations as expected, laying out the Fed's expected repo operations for the period December 13 to January 14, and it blew Mr. Scrim's expectations out of the water. According to the statement, New York Fed will continue to offer 2-week term repo operations twice per week, 4 of which span year end. In addition, the desk will also offer another longer maturity term repo operation that spans year end. The amount offered in this operation will be at least 50 billion, just as this gentleman, Mr. Scrim, expected. But there's more going on. In addition, to prevent a cascading year-end liquidity squeeze, Fed overnight repo operations will continue to be held each day. And just to be safe, the Fed will go to town by substantially expanding their size on December 31, 2019 and January 2, 2020. The overnight repo offering will increase to at least 150 billion to cover the turn in a flood of overnight liquidity. In addition, on December 30th, the desk will offer 75 billion repo that settles on December 31. And just in case that's not enough, New York Fed's market desk will also added that it intends to adjust the timing and amounts of repo operations as needed to mitigate the risk of money market pressures that could adversely affect policy implementation. And okay, so basically here we go again. I know we're all understanding this already. Fed's in it. They're not going to leave the repo market. They are basically the repo market. Quite amazing what they're doing. So let's take a look at some of the comments here. Rumpelstiltskin, how you doing, buddy? USA is way out of control now. When history books are written, people will sit back and think, what the heck or what the hell was USA doing? Had it gone totally mad. That which is not broken does not require fixing. Implications of the repo market should be obvious. I think it is. I absolutely think it is. Let's see. I literally thought that read Skyrim. Christy, so did I. I thought it was Skyrim, and then I'm going on to think Skynet, and then I'm going on to think AI and all these other things. But yeah, it's Scrim, I believe. So we'll have to get a correct pronunciation of that gentleman's name. Let's see. Dutch partisan. The dollar value of PMs is not important. Correct. Your purchasing power is correct. Absolutely agree. When silver goes to 300, you will still be able to buy the same goods with them. Yeah, when if silver gets to 300, we are living in a different world. I'm you may want to use it, you may not want to use it. You may want to, definitely use it for to acquire things like maybe land, maybe a business or things like that. Because unfortunately, the guys who don't hold silver or gold, and they are going to need a store of value. And if they don't have that store of value today, they should consider getting it tomorrow, because when these things happen, they're going to happen quick. They're definitely going to happen quick. And so again, you want to make sure that your fiat is in something that can store the value of what your fiat currently holds today. So that's a very good point. Let's see. Which country, nameless, hey, which country offshore has the most scams involving precious metals and trust scams? Nameless, that's a good question. Percentage wise, I can't give you a list as to which countries are, hotbeds for scams. This is something you really would have to check out yourself. Be sure to call people. Be sure to call these bullion dealers. Be sure to call the vaults where things are going to be stored offshore or sold from offshore. And I can tell you there are a lot of scams out there. There are a lot of people, companies pretending to be something that they're not. And there are other companies who put up shells, in a sense, to kind of funnel your thoughts into getting business from them. I mean, an example would be, let's say, like pages that give reviews. You need to be extra careful of those. And we even did a video on that, where when you have a bullion dealer who is pretending, or a bullion dealer is has, let's say, an interest, or they have a website that they do well on, and they try to more or less funnel opinions into thinking that they're the best operation. But when you find out they actually take care of the website itself, that is making you, trying to get you to think a certain way. That's not exactly a good way to start a relationship now. So again, even review websites, you need to be careful of those types of things. And we do have a video about that. I think you guys should take a look at it. Um, anyway, moving on, some of your other comments. Rumpelstiltskin, 2020 Federal Reserve will be buying 40% of all U.S. Treasury and bond issuance. Uh, yeah, yeah, that's a good point there. Definitely a good point. So, with all this talk about the repo market, I want to go ahead and take a look at the website itself. This is from the New York Fed, repo and reverse operations. So this is what, excuse me, what the Fed has been doing lately. So reverse repo, zero. Okay. Then we have repo. In the repo market on December 13th, 35 billion of treasuries were submitted. The interesting part, mortgage backed. Geez, I think my neighbor's doing some construction again. Anyway, apologies for the noise there, the drill in the background. Interesting thing, we saw mortgage backed at, 11 billion or so before, but look at it now, 20 billion. 20 billion in mortgage backed securities that the Fed is taking in the repo market, along with 35 billion treasury. You got to ask this question: what's going on? Why so much mortgage backed again? Okay. Reverse repo 600 or point 600 billion, and the Fed took in 37 billion and also another 12 billion mortgage backed. So let me go down. 8 billion they took in, 11 billion mortgage backed. these mortgage-backed numbers are no joke. They keep getting bigger. 25 billion treasuries, 16 billion mortgage backed. So if you're noticing, there are more and more mortgage-backed securities that are coming into the repo market, and you don't hear much about that, do you? All you hear is treasuries, securities into the repo market. Not many people are telling you about the mortgage-backed securities that are coming in. And again, we're hitting 20 billion now. Before it was just 6 billion, 7 billion, then 11 billion. Now we're up to 13, 15, 20 billion all coming in. So, I think somebody's gotta question this. Someone really needs to question this as to what's going on, where the Fed has basically become the repo market. And again, Congress has been paying attention, and in that grilling of Steve Mnuchin, this is one of the items that was brought up was the repo market.
I want to turn and mention a couple of things that we've talked about today on the repo market that Mr. Perlmutter talked about and the ranking member. I think the concern is that the New York Fed's not supporting the repo market. They are the repo market. I think that's the challenge. And we don't see the bank reserves that are more than adequate, billions more than needed. On JP Morgan, for example, $120 billion in daily cash held at the Fed on a $60 billion cash requirement, and yet they're not entering that repo market. So I'm pleased that yesterday at the FSOC meeting you talked about this, because I do think supervision is an issue here, and the stigma attached with something that was a regular part of our business lives, which is running a daily, intraday daylight overdraft at the Fed. On mortgage servicing, I appreciated your comment there. Again, that business shifted out of the bank sector to the non-bank sector because of Dodd-Frank. And for 5 years that I've served in Congress, I've tried to get the Obama administration and the now Trump administration to support the idea that mortgage servicing rights are not a derivative that should be treated in that manner. It's a natural, as you know from your long career in mortgage finance, a natural companion to the origination of residential mortgages. So I hope FSOC will lend its weight that allow mortgage servicing to not have the capital penalty that they have in Dodd-Frank.
Okay, so looking at the comments again, Rumpelstiltskin. The Fed is even buying CLOs. These things are not so good. The U.S. taxpayer via the Fed is buying up all the junk from the world's banks. It's interesting that you said CLOs, because what we saw this congressman say was something along the lines where mortgages moved from financial to non-financial. Okay, meaning could be wrapped up in these CLOs, just as you were saying. Where Dodd-Frank was meant to basically regulate the banks a bit more, the financial. Somehow these things moved over into non-financial, the corporate side, the CLOs. And when it comes to the repo market, let me just go back to that one real quick. When it comes to the repo market, again, now we're seeing these mortgage backed. So who goes into the repo market? A lot of times it's hedge funds, or I should say it could be more like, it's not just the banks, it's also the bigger funds that can come into the repo market. So is this mortgage back part of those perhaps non-financial, the CLOs, or the corporate the corporate entities that have been taking up packaged up mortgage backed securities and CLOs? I mean, we don't know, but I tell you what, it's growing. As I said, 16 billion. Even the first one that we saw was some 20 plus billion. So something's going on again in the mortgage market. 20 billion. So this is something we got to keep an eye on. And in fact, as these gentlemen have been saying, where the Fed is the repo market, what we're seeing from Reuters is now U.S. Fed seen launching repo facility in early 2020. This is coming from Deutsche Bank. and we're going to be talking about Deutsche Bank real soon as well. But the Federal Reserve may launch a policy tool to lend to banks using treasuries and other securities as collateral in early 2020, with possible testing to begin later this year, coming from Deutsche Bank. Such a standing fixed rate repurchase agreement or repo facility would serve as a backstop against sharp spikes in interest rates in monetary markets, or money markets, I should say, which are occurring with growing frequency at a month and quarter end. Sorry about that. We reaffirm our expectations that the Fed could test its facility later this year and launch it for full scale operations early 2020. Fed policymakers debated the merit of a repo facility in June. Before all of this stuff happened, they were already debating the merit of a repo facility. There's no consensus yet on the design of the facility. Other Wall Street analysts questioned whether a repo facility would happen anytime soon, when the central bank may end its balance sheet normalization and restart its purchases of treasuries sooner than it's planned. How true that is. Our base case remains for this facility to be implemented eventually, but we think it can take longer than we previously expected, around Q3 2020, given diverse opinions on the parameters from the participants. Okay. So, but for me, the interesting thing right now is you have all these banks, but the banks, they just don't want to lend money to each other, and or for some reason they don't. If they lend to each other, they want to get a higher interest rate on it, and that's again interesting, because I would think the banks all know what each other is doing, and if I came to you and asked you to borrow money, and you told me, hey, your credit's no good, I'm going to have to charge you more. That it's very concerning. Where for some reason these banks don't want to lend unless they lend at a very much higher rate, and so we're gonna touch on this as well. In fact, let me go into that article where we have again from Reuters. U.S. banks reluctant to lend cash. And we've seen something along these lines in our last live stream where the BIS, had their say. Anyway, Reuters reports the unwillingness of the top four U.S. banks to lend cash, combined with a burst of demand from hedge funds for secured funding, could explain a recent spike in U.S. money market rates. This is coming from the BIS. This is their opinion on it. Cash available to banks for short-term funding all but dried up in late September, and interest rates deep in the plumbing of the U.S. financial markets climbed into double digits. This was that start of that repo spike back in September. This forced the Fed to make an emergency injection of billions of dollars for the first time since the global financial crisis more than a decade ago. Okay, so last time it happened, global financial crisis. While the exact cause of the squeeze is unclear, with explanations ranging from large withdrawals for quarterly tax payments, which we don't believe, to a big settlement of a trade in U.S. Treasuries. Not sure about that either. BIS analysts said the growing reliance on the biggest U.S. banks to keep the repo market functioning may have been a big factor. So the big four banks, which the BIS did not name in its report, have become net providers of funds to repo markets, as they account for more than half of all treasuries held by banks in the U.S. at the Federal Reserve. Repo market underpins much of the U.S. financial system, helping ensure banks have liquidity to meet their daily operational needs. Okay. So you gotta kind of question these things and wonder what the heck is going on. Somebody's saying this, someone else is saying that, and nothing seems to be in a clear cut straight line. So anyway, back to your comments. Joel Johnson, banks don't trust each other. Yeah, absolutely. That's where we're headed to, or that's where we are right now. Even the banks do not trust each other, and there's a good reason for that. In fact, there's one bank in particular, and we're going to have to take a look at that also. This is from Wall Street on Parade. They offer some pretty good articles where the repo loan crisis, dead bankers, and Deutsche Bank timeline of events. So this is a bit dated, September 30. Let me make this a little bit bigger. Hang on. Okay. So again, dated September 30th. Last week, as the Fed was carrying out hundreds of billions of dollars in emergency loan operations on Wall Street for the second week in a row, the first such operation since the financial crisis, Deutsche Bank's headquarters office in Germany was being raided by police for the second time in less than a year. That's not the sort of thing that inspires confidence among depositors to keep their money in your bank. Okay, so straight away, if you're a bank, are you going to be trusting Deutsche Bank? Probably not. DB has been a constant headache for the U.S. financial system because it is heavily intertwined via derivatives with big banks on Wall Street, including JP Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley, Bank of America. It has become the dark cloud on the horizon in the same way Citigroup cast a negative pall in the early days of the financial crisis of 2008. The early days, okay? It's not a good omen that Citigroup stock eventually went to 99 cents and the bank received the largest taxpayer and Federal Reserve bailout in U.S. history. Fed alone secretly pumped 2.5 trillion in revolving loans into Citigroup. The latest raid at Deutsche Bank, or DB, occurred on Tuesday and Wednesday of last week. Again, this is earlier in September. Well, here we go, September 24, 25. It was related to the 220 billion money laundering probe of Danske Bank, Denmark's largest lender. DB served as correspondent bank to Danske's Estonia branch, where the laundering is alleged to have occurred. As the raid was proceeding, the body of Ivar Rihi, who previously ran the Estonia business of Danske Bank, was discovered by police in Estonia. He had been questioned by prosecutors and was considered a key witness in the probe, and basically he committed suicide. On the day the police started the raid at DB, the Federal Reserve Bank of New York offered $30 billion in a 14-day emergency term loans and had demand for more than twice that amount. That led the New York Fed to increase its subsequent 14-day term loans from $30 billion to $60 billion later in the week. The Fed's overnight repo loans that were offered every day last week were also increased from 75 to 100 billion per day. And there is a timeline. I may or may not get into it, but Deutsche Bank has been in a slow motion collapse as a result of its serial crime charges, while international regulators have failed to address the fact that it is a counterparty to 49 trillion in derivatives, according to its 2018 annual report, and thus presents systemic risk throughout the global financial system. Okay, so we're having Deutsche Bank it's a systemic risk, and again we go back to Congress when Steve Mnuchin was there, and they even asked him about Deutsche Bank and what's going on with it.
In June 2017, Treasury issued a report on banking deregulation. It suggested that if Congress raised the $50 billion threshold above which U.S. banks are subject to stricter oversight, that Congress ought to do the same for foreign megabanks. Earlier this year, the Fed followed that Treasury recommendation and massively deregulated foreign megabanks, and that was an item on a wish list that you published in 2017. There's a lot that concerns me about this, but the most glaring for me is about Deutsche Bank. I'm sure you're familiar, the chairwoman is very familiar with Deutsche Bank. They would now only need to submit their living will once every 6 years. And this is the same Deutsche Bank that within the last 6 years had a surprise $3 billion quarterly loss. I don't know how you lose $3 billion and not see that coming. Has failed its stress test in 3 of the last 4 years, was fined for a mirror trading scandal involving laundering money for Russian oligarchs, admitted to participating in LIBOR interest rate market rigging scandals, and violated U.S. sanction laws against Iran, Libya, Syria, and the Sudan. Why why are you advocating, why did you advocate to deregulate one of the worst corporate recidivists operating in the U.S. banking system, particularly when it is not even a U.S. bank?
Well, let me just first say I share many of your concerns about Deutsche Bank. I obviously can't comment on any of the specifics because from a regulatory standpoint, it would be inappropriate for me to comment specifically on Deutsche Bank. But I share many of your concerns, and particularly the sanctions evasion is something that we will not tolerate by anybody, domestic or internationally. I think the issue, so I'm going to answer this generically, not as it relates to Deutsche Bank. The question is, the banks will be regulated. So the U.S. subsidiaries and the way that we've changed the structure, there's intermediary holding companies so that the foreign subs that are effectively U.S. institutions, we can look at the risk at that level.
I understand, I understand the subsidiary foreign relationship. I just don't understand why, when we would do something that is deregulating one of the worst actors in the marketplace, and particularly when it's a foreign bank operating on our soil and threatening the stability of our markets. I understand there's a balance between regulating the industry and stifling capitalism, but if you do share my concern about Deutsche Bank, this gives us one less tool.
Pretty interesting. So yeah, I mean the Congresswoman did bring up a good point where why are we in a sense deregulating Deutsche Bank after all that's been seen with what they're doing, and she did raise a good question. I'm curious what you guys think. Why is everyone coming to Deutsche Bank's rescue? Is it because the way the system is, all banks are so deeply intertwined that if one goes down, they may all go down, and that's where it seems like everybody's coming to Deutsche Bank's rescue. The interesting thing is, with all these people coming to their rescue, you take a look at their stock price, it's not really moving. So again, is this one of those so-called zombie banks already? Has it reached that point, where again, they're like Bernie at Weekend at Bernie's, and everybody is trying to convince everyone else that hey, they're doing just fine. Don't worry about it. They're alive and kicking. So Deutsche Bank, it is something that we all need to be aware of as well as along with those CLOs, and those two alone make sense as to why the repo market is as active as it is, or why the Fed has become the repo market. Those two things would definitely, surely make sense. Okay, so let's take a look at some of these comments. Pablo Pina, all it takes is one domino in a chain. Yeah, absolutely, absolutely. And Deutsche Bank or DB is definitely one of those dominoes that does look to be wavering a bit. So we, again, interesting. Mark W, interconnectedness is the reason. I'd have to agree with you, buddy. I mean, if these banks were mom and pop banks the way they were before, if one went down, it would be okay. Most of these, it seems before the banks were more or less compartmentalized, where they weren't so intertwined the way they are today. And I think banks do need some type of compartmentalization where if one goes down, the others are still okay. Because if one goes down right now, seemingly the whole financial system's going to go down. Let's see. Robin, stable, totally weak at Bernie's. Yeah, that's the way I seen it, and I think they even had a weekend at Bernie's too, right? So it's going to go on and on, and again, these are exactly the reasons why we need to be into things like gold and silver, because when they do go down, it's going to go down quick, it's going to go down hard, and you need to have something outside of the system, and gold and silver do fit that. Yeah, they absolutely fit that. Store value, they're like an insurance. You look at central banks today, they've been buying more gold than what the past 50 years or so, and they're continuing to buy. You look at what nations are saying about creating their own cryptocurrency, with central banks holding gold as reserves, probably are looking at some type of a gold-backed crypto in the future. So we're going to have to see how these things all play out. And I want to show you one more clip that a gentleman from Congress had to say. It's pretty interesting also. So give it a couple minutes.
I asked my staff to just kind of give me some numbers on student loans, on auto loans, and on corporate debt. I mean, we're at $1.6 trillion in student loans. 44 million Americans have student loans, 29, almost 30,000 the average debt. Auto loans, we're at 1.26 trillion. 107 million Americans have auto loans. 7 million Americans are more than 3 months behind. And corporate debt, we're at 10 trillion, 1.3 trillion in leveraged loans, 1.2 trillion in junk bonds. I mean, there's a lot of lending going on out there. And so the question is, are we getting overextended again? And that's what I'm worried about.
The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Ms. Secretary, did you want to answer that?
Thank you. What I was just going to comment on is I think it's a good thing that we have a lot of lending, a healthy economy. And again, I really do think that this bank issue is a highly technical issue, but it is something we are very focused on. And student loans, that's a longer subject that we're studying carefully. We share certain concerns on the student loan market right now.
Are we overextending again? That was a good question set forth by the congressman. Are we overextending again? Steve Mnuchin, Treasury Secretary, his opinion is lending is a good thing, but are we overextending? And that's in part what got us into trouble last time. So, the thing is, if you notice, I played quite a few clips from congressmen as they were, in a sense, grilling Steve Mnuchin, which is going to take me into the second part of the live stream where, what exactly is Congress doing? And so I went ahead and took a look at some of the bills that have been introduced in Congress this term as they pertain to gold or, let's say, things with the Federal Reserve. And I just wanted to share a few of them with you. I have 10 actually wanted to share with you. And then just get your opinion. Is it a thumbs up or a thumbs down? So the first one I wanted to take a look at is House Resolution, or HR. I believe that's what HR is for. 2558, the dollar defined with gold. Hang on, it's just loading up. Let me close a few windows. Let me just close a few down. Okay. So Congress, geez, is this thing going to load up or what? Hang on, guys. Let's give this a little bit of a chance to load. Okay, here we go. Sorry about that. So the first bill we have is from Representative Alex Mooney from West Virginia. Okay. What he is saying is he wants to define the dollar as a fixed weight of gold. So he goes on to say, or why did he propose this bill? The US dollar has lost 30% of its purchasing power since 2000 and 96% of its purchasing power since the end of the gold standard in 1913. 96% of its purchasing power. Under the Federal Reserve's 2% inflation objective, the dollar loses half of its purchasing power every generation, or 35 years. American families need long-term price stability to meet their household spending needs, save money, and plan for retirement. So what do you guys think? Is this a thumbs up? Is this bill a thumbs up or a thumbs down? Do you like it? Do you not like it? Amazing thing, there are no co-sponsors. This gentleman is on his own. Nobody is supporting him with this bill. Nobody in Congress is supporting him with this bill to define the dollar as a fixed weight of gold. Well, for me, for what it's worth, it's definitely a thumbs up. Definitely a thumbs up. I'll give this gentleman a thumbs up. So another bill, HR 3, I believe it's 3559 or 2559. Again, from Alexander Mooney from West Virginia. The bill he introduced is to provide for the first true audit of gold owned by the U.S. in more than 65 years and subsequent audits every 5 years. So what he wants is a full assay inventory and audit of all gold reserves, including any gold in deep storage. Quotations, deep storage. What's that about? Of the U.S. at the place or places where such reserves are kept. An analysis of the sufficiency of the measures taken to ensure the physical security of reserves. I think you guys get it. He basically wants an audit of the U.S. gold, and he wants to define the dollar as some weight of gold. For those two, I'll definitely give him a thumbs up. Give him a thumbs up on for those two things. Okay, so let's see. Name this. What's some other forms of gold besides nuggets, foil, currency bars, and coins? Teeth. I know people out there got their gold tooth. So, just kidding there. I think in this case, it's really the bullion that counts. That's the more tradable type of gold. Not to say you shouldn't have any. If you can get your hand on some nuggets, definitely get your hands on some nuggets as well. Not to say that you shouldn't be looking at those things. Let's see. Okay, so let's take a look at another one. This one I found pretty darn interesting, and I hope you folks might find it interesting as well. This is from the Senate, Resolution 182, a resolution recognizing the duty of the Senate to condemn modern monetary theory, and recognizing modern monetary theory, or MMT, would lead to higher deficits and higher inflation. So this is the bill to condemn modern monetary theory. This is from Senator David Perdue out of Georgia. And hang on, let me click on text to see what his bill states. Okay. Recognizing the duty of the Senate to condemn modern monetary theory, and recognizing that the implementation of MMT would lead to higher deficits, higher inflation. Okay, he does have a few sponsors, which is good. So he goes on to say, MMT is fallacious at multiple levels. Past a certain point, MMT leads to hyperinflation and a policy of relying on central bank to finance government deficits, as advocated by MMT theorists, would likely result in a collapsing exchange rate. Jerome Powell is on record as saying the idea that deficits don't matter for countries that can borrow in their own currency, I think, is just wrong. Janet Yellen was quoted as saying, that's a very wrong-minded theory because that's how you get hyperinflation. Janet Yellen talking about hyperinflation. Goes on to say, MMT has a flawed model of inflation which overestimates the importance of economic slack. Let me go down a bit. Stan Vogler, I suppose is his name, of the American Enterprise Institute warned that hyperinflation becomes a real risk when a government attempts to pay for massive spending by printing money. Well, isn't that nice? These guys talking about condemning MMT, and they know that printing money leads to inflation, but what are we doing? We're printing money trying to get inflation. Dude, I don't think you and I want that inflation, but the central banks the central banks want that inflation. So that one I find pretty interesting. They're looking to condemn MMT. I hope they they do it. I'm for that one. Thumbs up as well. Mike Capin, yeah, agree with you. Thumbs up there. Then we take a look at another bill in the Senate, 148. Sorry, yeah, hang on, 148, which is to require a full audit of the board of governors of the Fed and the Fed banks by the controller of the U.S. So previously, Alexander Mooney wanted an audit of the gold held in reserves, and now we basically want to audit the Fed. And this is by Senator Rand Paul. He wants to get that Fed audited. In short, this will be called the Federal Reserve Transparency Act of 2009. And he wants the Fed no later than 90 days after the date on which the audit required, pursuant to subsection A is completed. The Comptroller General shall submit to Congress a report on the audit and shall make the report described in subparagraph. Okay, basically, he wants to audit the Fed. And I'll give 2 thumbs up for that. I think the Fed does need to be audited. We need to know, who's dealing with the Fed, where's the money going, why are they dealing in such ways, especially repo market, shadow banking, and other things like that. So I think this is a good bill from Rand Paul. This one here, everybody pull up a seat, pay attention to this bill, because this bill going to have significance on maybe perhaps just about all of us. It's from the Senate, 2120. Government Bailout Prevention Act. You folks getting that right? Government Bailout Prevention. This is from Senator Todd Young from Indiana. His bill proposes to prohibit the provision of federal funds to state and local governments for payment of obligations, to prohibit the Federal Reserve banks, the Department of the Treasury, and other federal agencies from financially assisting state and local governments that have defaulted on their obligations and for other purposes. Are we understanding this? This is to prohibit the provision of the federal funds to state and local governments for payments of obligations. In other words, you're not going to get any help. If your state's in trouble, your state is on its own. If your state cannot meet its pension obligations or anything else, you are on your own in that state. And we've talked about this before, where pension is just a promise. And now here we have in Congress where they are already making the provisions or putting a bill forth that they're not going to help you, or they're not going to help the state that you're in. So things are starting to get set up in certain ways that we've all talked about before, and these are things that you're not exactly hearing in the news about what Congress is essentially doing. Some things are good, some things can have some pretty harsh implications. And the thing is, it's not your fault, it's not my fault. We've been doing what we're supposed to do, but our, in this case, state governments are not doing what they're supposed to do, and the federal government is saying, we're not going to help you. If things really get bad, we are not going to help you. I'm not sure if I want to give this a thumbs up or a thumbs down, because let's say if my state gets in trouble, hey, I'd appreciate the help. But then again, if let's say some other state got in trouble, now I'm having to help relieve that state, because if the federal government steps in to help that state, that means all of us are stepping in to help that state, which means your state can be responsible, another state can be irresponsible, and we're all going to have to clean up that mess. I mean, I understand, let's all help each other out, but we also can help each other out by taking care of our own house, by keeping our house in order. So this one's pretty interesting. I'm not sure if it should either be a thumbs up or a thumbs down with that one, but it's, as RF3 says, accountability. It's about accountability. So this one, I do find pretty interesting. Another one that's pretty interesting is this one here, where we know the FOMC, they basically prescribe a interest rate for banks to loan to one another. More or less, that's what it's about. So this senator, he says, hey, if it's good enough for the banks, then it's good enough for students. So this bill is coming from the Senate, S 1845. This is from Jeff Merkley out of Oregon, where what he's saying is to enable borrowers of federal student loans to refinance those loans at interest rates that are equivalent to the interest rates at which the federal government provides loans to banks through the discount window operated by the Federal Reserve System. I tell you what, you know, one half of me is yeah, that's right. We should. Why aren't we getting those breaks? The other half of me is, well, the whole business, the purpose of a bank is to try and get some money or some interest. So if we're getting the same rate as the bank, we're not going to go to the bank to get a loan, right? And that would kind of put the banks out of business, which sometimes may not be such a bad thing. But nonetheless, pretty interesting. Should students be able to get their loans refinanced and get at that same rate at the discount window that banks are getting their money at? Okay, so let's see what some of these comments are. Okay, let's see. RF3, now think about California pensions fund being depleted. Make the connections, people. Yeah, California is in pretty bad shape. A lot of states are in pretty bad shape. Let's see. Full name. Should a country's politicians hold allegiance to a foreign country? Oh, that's a good question. I mean, I think when you vote for a politician, you're voting for that politician to take care of your country and take care of things within the borders, not really to go and meddle too much outside of the country's borders. That's a pretty good question. Rumpelstiltskin, 1/3 of U.S. student loans are either behind or in default now. Yeah, it's a mess. Where are we at? 1.5, 1.6 trillion now. It's quite a bit. So this congressman is saying, hey, you know what? Let's give these students the ability to refinance their loan, and when they refinance the loan, hey, why not give it to them at the same rate that that the banks get it? The problem with that is, or one of the problems, people who own homes, they're gonna say, hey, refinance mine as well. Auto loans, refinance mine as well. Everything's gonna be refinanced. You can't just give it to one particular demographic and not the rest. So I don't exactly know what's his purpose of throwing this bill in there. Perhaps it's just to get reelected. A lot of times they'll do that. So we'll have to see how that one pans out. And I know last time we had a gentleman, I forgot his name. He was talking about Facebook and Libra, and I do have concerns with Libra, and so does Congress, and so does my internet. So let me see if okay, something's gone down. I hope the guys doing construction didn't mess things up for me. Anyway, there was a. Let me see if I can. Hang on, I'll move on. So there was a congressman. He basically is saying big tech should not be involved in the financial sector, and this is the congressman's name, Jesus Garcia, where he introduced a bill to keep big tech companies out of the financial sector. And let's see. So this congressman, Jesus Garcia from Illinois, questioned Facebook CEO Mark Zuckerberg on the introduced HR 4813, the Keep Big Tech Out of Finance Act, which would block Facebook from developing its controversial Libra project. The bill prohibits Facebook and other big tech companies from developing digital currencies. How do you guys feel about that? Apologies, couldn't get that bill to come up, but this congressman did introduce a bill where he's basically going to block big tech companies from entering the financial sector. I think I agree with this congressman. Anyway, let's see where you guys are at. Let's see. Thomas Tubes. When I lived in Johannesburg, it didn't take very long for U.S. checks to clear, but then again, they weren't for $1 million, just a few thousand. Okay. I guess are you saying that's because the dollar was more or less well received at that time, so they trusted it? Um, okay. Well, sorry about that. I'm trying to follow it. I may have fallen behind with the comments here. Uh, Bobby Jones, yes. Block, big tech. Yeah, I agree with that, and that's why I kind of have an issue with Libra. I think social media is just controlling too many parts of our lives as is, and you don't. I don't think you want to let it start to control your money or your transactions or your currency or anything like that, because like I say, when you look at you hear these things about social scoring and whatnot, very easy now. I mean, you're using their social platform, and if you say something that they don't like or whatever it is, next thing you know, you can't transact. So I'm not a fan for it. I do think this congressman is on the right path. I agree with him. I'll give him a thumbs up. I definitely give him a thumbs up for that. So let's see if that bill comes up yet. Not sure if it will, but I just want to go back to it. Yeah, okay, it's down. Another interesting one was, geez, maybe that whole website is down. Another one can't get to. Okay, but another one was basically they're talking about crypto and how crypto needs to be something that's recognized, and we need to understand it. And we did even have Christine Lagarde, where she came out and said this.
My personal conviction is that given the developments we're seeing, not so much in the Bitcoin segment, but in the stablecoins projects, and we only know of one at the moment, but there are others being explored and underway at the moment, we'd better be ahead of the curve if that happens, because there is clearly a demand out there that we have to respond to.
Okay, so Christine Lagarde, the head of the ECB now, former head of the IMF, she's saying that she's not really looking at Bitcoin, and I think one of you mentioned this earlier. She's not really looking at that. What she's looking at are stable coins. Stable coins, typically they have some type of a backing to it, whether it's like Tether has the US dollar. Other cryptocurrencies, they have gold tied into it in some way, shape, or form. And I think that's more or less what she's looking at with these stable coins. Is the central bank or the ECB needs to get ahead of the curve, because today cryptocurrencies are really moving forward and making central banks out to be a dinosaur. So I think these central banks are going to have some pretty drastic changes in order to stay ahead, as Ms. Lagarde mentioned. So again, what she says is pretty interesting, and even Congress has they've made it the point that we need to take a look at crypto.
Had a lot of conversations about digital currencies. Jay Powell just answered our letter on the idea of a digital token. And I think the concept's a little misunderstood. If we want a digital future in finance and we want to protect the preeminence of the American dollar as a reserve currency, this idea of a digital token is an important concept. And it's not anything except allowing our government to facilitate a blockchain transaction process legally in the future. We have Visa debit, we have MasterCard, we have SWIFT, FedWire, the ACH system, all true, all have private sector participation in them and government participation. But this idea that there's a new rail created that's a blockchain rail that both bank and non-banks can participate in to settle transactions through a token, it's coming our way faster than we like, perhaps faster than the 5-year time frame you outlined. So I do think it's an important issue for the FSOC to continue to consider, and also to have Treasury's view on, independent of what your agent over at the Federal Reserve thinks as you implement Article 1's power on currency.
Okay. So ECB is acknowledging there needs to be stable coin, or they're looking at a stable coin. Congress is acknowledging that the 5 year time frame might be very well too long, too long. So we're looking inside of 5 years. And again, if this comes to be, I think we're looking at an overhaul of the current financial system where things are going to change drastically. And some of you guys mentioned, about blockchain and everything going up on it, and if if you're comfortable with that or not, uh, it's it's something that I think everyone has a different tolerance level for. So we'll see how this part pans out as well. But just to give a heads up, our government and or our central bank and our other governments or central banks are looking at crypto or some type of a stable coin. So again, things are going to change, and this is where when this transition happens, it I don't think it's going to go very easily. I think there are going to be some hard times in there, and again, this is where you want your gold and silver to help you get through that transition from here to there. And that's the most important part is that transition, because during that transition, I think a lot of people are going to come across hard times, but I think there's going to be a lot of opportunity as well if you took the time to understand how things like gold and silver can help you through that transition, because again, that transition is going to be key. But an article came out from Zero Hedge also is pretty concerning, where they mentioned that almost two-thirds of the mining basically is done in China, where hash rate domination, China controls two-thirds of the world's crypto networks processing power. Um, that can be a very, very big deal. That can be a huge deal. They have over half of the world's processing power. Anyway, a new report, again from Reuters, citing CoinShares. So CoinShares indicates that China's Bitcoin miners now control a whopping 66% of the world's crypto network's processing power. Could be bad news for U.S. miners, as it signals China is quickly advancing, also known as hash rate. It's the speed at which a computer is performing an operation in Bitcoin code to unlock coins. China has been steadily gaining hash rate share this year. Let's see. China's Bitcoin miners controlled 60% in June, and now they're 66% in December. That's a pretty quick jump. Chris Benkison, head of research at CoinShares, believes a rapid increase in Chinese share of hash rate could be due to the deployment of advanced mining technology. This is beneficial to the Chinese mining industry. If you are the first to increase your proportion of the hash rate and you can do that before your competitors, that's generally good. Mining crypto has become more difficult over the last several years as profitability sags. The overall Bitcoin hash rate has risen 80% since June, which in recent times has created stronger profitability for miners who have access to cheap energy. So let me just go on a little bit down here. Blockchain is a technology field that China started to develop almost at the same time as other countries in the world, said Jiao, who was employed by the Chinese government. It's hard for China to claim technological supremacy on fields like internet, plus China's initiative on information technology or artificial intelligence, but blockchain technology would be a perfect fit for China's technological dominance. So, again, that's a little bit concerning if you have most of your miners in one country, and in a country that can very easily dictate what they want to be done. So that's pretty concerning. And again, it's another reason why, let's say, these central banks are looking at developing their own crypto, which I would think would mean they're in control of the mining, and not have mining be outsourced in some sense. Well, maybe they will, but who knows? But it's just to say that you can have a bit more control of these things for something that was supposed to have been decentralized, and that's the overall concern. You don't want it to run the risk of becoming centralized. So that's basically what I'm looking at there. So let's see. Pablo Pina, China can corner the processing power of crypto if they own two-thirds. That's exactly right. That's exactly right. That's why it's a little bit concerning. It's a bit concerning there. Let's see. Stan, Skeleton, Randy, Fresh. No time to take vacations. Keep your eyes on your own data. Regardless who has it, they'll be roped. Yeah. I'd like to buy shares in China's hash rate. Yeah, 10% in 5 months. Libra is a no-go. Raul Duke. You know, it seems that way. Congress is definitely putting up a few hurdles, if not a stone wall, a stone cold wall to block Libra. So we'll have to take a look at that. Uh, who's the biggest crook in the finance industry on YouTube? You can answer that one, man. I got no idea, no idea there. Let's see. Steve, Beaver State Plumbing. World War III will be fought over the reserve currency. There is less than 2 trillion paper currency, and U.S. debt is 23 trillion. Yeah, yeah. I think nowadays, what we see countries fighting over are resources more than ever. Whether it's oil, um, land, things like that. Maybe even water, minerals, things like that. I think it is going to come down to those types of things, and it's not an easy thing to talk about. But again, the one of the keys through all of this is you got to understand that gold and silver is more than just a price. There are things that it can do for you, and a lot of it is, if not all of it, is to your advantage. I know the price goes up and down every day. Some people they bought in 2011, they've only seen it go down. They will completely disagree. Are there better investments? Of course, of course. But is there a better insurance or better store value? Hard to say. Yes, I would have to say, for those types of things, gold and silver. That's where you want to be. Um, so anyway, we are seeing Congress starting to get a bit more active. We are seeing governments around the world starting to get a bit more active when it comes to what's going on with central banks and economies. So we need to really keep an eye on those things. But it's good to know there are some things that Congress is actually doing or thinking of doing. I do like the weight, the dollar having a specific weight of gold, maybe even silver. Don't think it's ever going to happen, but goes to show that at least some of our people that we've elected they're woke. They are awake, and I think anytime there's an election time, we got to find those people, and if we can't find them, we need to become them, because it's a huge problem that's going to affect everyone and for generations to come. So I'll take a look at a few more of the comments before we head out. Let's see. Time to quit government and govern ourselves. you know, I'm not for anarchy, but I tell you what, we need to get the right people in government. That's for sure. No matter where we are, we need to get the right people in. Let's see. Where about at where fiat money is a burning house ablaze. Yeah, we're kind of getting there, and the Fed is just adding more fuel to this fire. Starting to put money again in the markets. That balance sheet is growing, and as mentioned in the beginning, we're at least going to be what QE2 was. But the real question is, are we going to be between QE1 and 2, or are we going to be even equal to or greater than QE1? So we're going to have to see what happens with this. And the thing is, at least we know it's happening, which gives us time. So we have time to do whatever it is we need to do. HR 1089 looks to exempt capital gains from PM. Okay, I didn't come across that one, but I hope so. I hope so. Okay, so anyway, that's about it for this live stream. I'm going to be wrapping up. I got to head out and do a few things, but I do appreciate the time that you've spent here with all of us. We're all in the same boat together. We all need to take care of each other and as much as possible be a blessing, not a burden. We see what's going on, and try and find like-minded people where you can encourage one another, but at the same time, don't don't shut your ears to what other people are saying, because we need to take in information from all sides to be able to best decide what's best for us. So, with that, again, appreciate you being here, and I hope to see you guys next week. As always, saddle up for what's coming ahead and silver up as well. And I'll see you next week. Take care, everyone.